Welcome to our review session for exam number 1. This exam covers the first 4 chapters, so that's 15 through 18. And this is the 16th edition of the Financial and Managerial Accounting textbook. So I've put together a practice set as I do for each exam. This is not graded. It doesn't count directly toward your grade in any way. I can see who's worked on it, but I don't necessarily look at that unless there's a question. But to find this practice set, when you're in See Now, you need to choose the option that says either assignments I can practice now or all assignments. It doesn't show up on the default page, which is assignments I can take now, because it's not graded. And so it doesn't see it as something you're taking. So I'm going to work through each one of these exercises. As you can see, there's a brief selection from each one of the chapters. These exercises look like exercises that you can expect to see on the exam. And maybe when we're done, if we have time, we'll take a brief look at the exam as well, just so you can see what that looks like. So we'll start here. I'm not sure why I have these not in chapter order, but for some reason, my first exercise is from chapter 16. I'm sure you know that you can look at the title of the exercise and see that right after the EX, so exercise, the next number is the chapter number. And then you see this ALGO at the end. That stands for algorithm or algorithmically generated. So what that means is the numbers that I have in my exercise are going to look maybe a little bit different. Maybe some of the numbers, maybe all of the numbers will be different than what you have in your exercise. So the techniques, the way we go about calculating will be exactly the same, but you'll want to put your numbers in to your exercise so that you can check to see if it's correct or not. Also, this practice set is set so that you can take it an unlimited number of times. And so if you would find that useful, I've had people ask for this in the past, if you would find that useful, you can start the whole set of exercises over again, and that's going to regenerate the numbers for you as well. So you've got different numbers, same exercises, but some or all of the numbers will be different if you submit it and then start over again. So predetermined factory overhead rate, this is from chapter 16. And so we talk about the 3-step process for going through the traditional approach to allocating overhead. So the traditional approach is a one-size-fits-all. You have one factory-wide rate, and you use a 3-step process. As I said, the first step is before you're even making the product, you calculate that overhead application rate. You have to decide what you're going to use as the cost driver. That is the way that you are going to spread out or allocate those costs, those overhead or indirect costs to your product. And so for this particular company, we can see that they're using direct labor hour as their allocation base. Now, it doesn't tell us what the direct labor hours are, but you'll notice it does say that the direct labor is $544,000 and the average cost is $16 per hour. So let me get my annotate function up here so I can put some calculations here on the screen for us. So $544,000 divided by $16 per hour will give us the number of hours that the shop expects to work. And that would be 34,000 hours. Okay, so they expect to work 34,000 hours, and we're going to use that as the base for our calculation. Now, this calculating the predetermined factory overhead rate is step 1. We do that before we even start working. We decide for the period, usually for the year, how much is our overhead allocation going to be. What we need, in addition to the allocation base, which is the 34,000 hours, we need to know of all of these costs that are listed, which ones are going to be part of overhead. And so as we look at each one of these costs that are listed, the total costs and expenses, $1,651,900. That's all of the costs, but some of those are going to be direct costs. So we need to identify which ones of these are indirect costs. Well, we are TurboShop and we perform engine repair work. And so the engine parts, the first line here, would be a direct cost. So we're not going to include that in the overhead. We're going to be able to assign those directly to a specific job. The same thing is true for the direct labor. So the engine parts would be what we call direct materials. Then we have the direct labor. Shop and repair equipment depreciation, that would be an indirect cost. It's definitely part of the cost of doing the engine repair work, but it's hard to trace to a specific product or batch of products. The same thing is true for these shop supervisor salaries and the property taxes on the shop and the supplies. So all of those are part of the indirect cost of producing our product, which is engine repair work. Advertising expense would be a period expense. So think back to the chapter 15, that extra diagram that I have in the reference materials, where we know that we can divide all costs into product or period costs. Well, period costs are the selling, general, and administrative costs. And so that would include the advertising expense, the administrative office salaries, and depreciation expense. And so those last three items are not going to be included. So where I have those green check marks, those are going to be the costs that make up our indirect costs or factory overhead. We wouldn't have these costs if we weren't producing the product. And so when I add those four together, I'm not going to type out the whole calculation, but as I add those four pieces together with my numbers, I get $275,400 is the factory overhead. Whoops, factory overhead. And so now we have the two pieces of information we need to calculate the factory overhead allocation rate. Again, predetermined because we do this before we even start the year's work or the period's work. You'll notice it says estimated costs and expenses. So all of these costs in this list are budgeted or estimated costs. So because we're using direct labor, as I said, direct labor hours as our allocation base, we take the total overhead cost, $275,400, and divide by the expected level of the cost driver, and that's 34,000 direct labor hours. So 275,400 divided by 34,000. With my numbers, I get $8.10 per direct labor hour. But again, you're going to want to put in, the numbers, the same process, but the numbers that are in your specific exercise. So if you're watching this on recording, certainly if you have questions about anything that I've done here, if you're not sure how to use your numbers in place of mine in the calculations, certainly send me an email. And, if you need to ask for a time to meet, I'm always happy to do that. But we'll keep going. So let me clear my drawings off the screen and we'll move on to exercise number 2. So this is a statement of cost of goods manufactured. This is from chapter 15. And so this was our introductory chapter where we're really learning about how it works for a manufacturing company compared to or contrasted with a merchandising company that we talked about most of the way through financial accounting. Again, for most of you, that's last semester. So the statement of cost of goods manufactured is not a financial statement in the way we think about them from financial accounting. This is not something that would be prepared and shared with the wider world. You're not going to see this in a company's annual report, for example, but it is a very critical piece in our calculations because you can see here, whoops, The bottom line is the cost of goods manufactured, and that number is necessary for the financial statements in order to calculate cost of goods sold. So in order to know how much we sold, we need to know how much did we make in the first place. And so that's why this particular statement is a very important report for a manufacturing company. And we don't have that for a merchandising company because those companies aren't making their product. It's pretty straightforward. They have invoices from their suppliers that tell us how much each product cost when we bought it. And yes, as we learned in Chapter 6 in financial accounting, we still have to apply one of the inventory valuation methods such as LIFO, FIFO, average cost. But it's still more straightforward than for a manufacturing company where we actually have to calculate all of the inputs that were going into producing the product in order to know how much did it cost us in total to produce. So what we're doing in this exercise really is analyzing the flows in and out of the work in process inventory account. And if you look in, let me go back here. If you look in Brightspace in the chapter, well, I don't know why it's not going. Oh, there it goes. So in this, in Brightspace, in the reference materials folder for chapter 15, hopefully you've already seen this. I have this flow chart, and you know, it's very rudimentary. This is actually a photo that I took of me writing on the whiteboard. You can ignore all of the dollar amounts. But really what we're doing is looking at what happens here in this work in process account. What started in there? What did we add to it? What did we take from it? And so what do we have left? So if we look at these arrows, this flow chart, we have our beginning balance in work in process, and that's where we're going to start with this calculation. Then what did we add to it? Well, you can see the arrows that are flowing into this work in process account: direct materials that were requested, direct labor that was applied, and then overhead that's allocated based on some allocation method like we just talked about in the first exercise. And then we know what we have left in work in process at the end of the month. And so the part that was moved out then is the cost of goods manufactured. That's the cost of the product that we completed. And so what's included in there? The 3 product component costs: direct labor, direct materials, and overhead. And so that's what we're going to be doing in this exercise. So we start with our beginning work in process. So if we look at the 3-line heading that all financial statements and reports should have: name of the company, what is the statement or report that we're preparing, and what's the time period that it covers. So this is for the month ended January 31st. So the beginning balance would be work in process as of January 1st. So with the information that I have in my exercise, I can make this, I think, a little bigger. With the information I have in my exercise, my beginning work in process was $57,600. What's included in there? Again, direct materials, direct labor, and some overhead that's been applied. So that's product that we had started last year, but we weren't done with it. And so it's still sitting in work in process inventory on our balance sheet at the end of December. And therefore, that's our opening balance for January 1st. Well, then, as we saw in that flow chart I just showed you, we add 3 separate costs into that work in process account: direct materials, direct labor, and then we apply overhead. So in this case, the direct materials used in production is given as $128,000. Now we could be asked in a more complex problem, we could be asked to calculate that cost of direct materials. And so going back to our flow chart, we'd be looking at the same kind of analysis for this materials inventory. What did we start with? What did we add to it with our purchases? What did we use? And what do we have left? Because this is a briefer exercise, we're actually given that number, but certainly we could be expected to know how to calculate that. Direct labor, 153,600 using my numbers. The number in your problem may be different. And then the factory overhead. And again, we're given that number here, but we could be asked to calculate that based on, just like we saw in the previous exercise, based on the overhead allocation rate and the actual level of the cost driver. In the previous exercise, I talked about overhead allocation being a 3-step process. And so the first step was to calculate the predetermined overhead rate. The second step is to apply overhead based on that predetermined overhead rate and the actual level of the cost driver. And then the third step is to reconcile that. That is to make sure that we have not over or under applied that overhead, making corrections as needed to make sure that we are including the actual amount of the overhead at the end of the period. So now our total manufacturing costs incurred, these are going to be the costs that were added to the account during the period. So we're just adding those 3 pieces together. And I got $352,000 with my numbers. And we add that then to what we had in the account at the beginning of the month, and we see the total manufacturing costs that were in that work in process account at some point during the month, $409,600. And if we then subtract from that what we had left at the end of the month, and that's given in my exercise as 78,100, yours is slightly different. We're going to subtract that to get the cost of goods manufactured. And as I said, that cost of goods manufactured number is going to help us to calculate the cost of goods sold. And so there is the statement of the cost of goods manufactured. Again, a simplified version here, a little bit simpler than what maybe we did in the exercises in the chapters, but you should be able to know where those numbers are coming from. Again, you can refer to this, and if you find that kind of convoluted and messy, I would encourage you to also look at the basic calculations for a manufacturing firm here. These formulas are going to help. This is exactly what we just did right here. But we also have formulas for finding direct materials used. That's analyzing that direct materials account, and to find cost of goods sold, which is the part that you need for the actual income statement. So always make sure you're looking at those reference materials folders. And if there aren't any questions, we will keep going. So also in chapter 15, to get us started with the transition again from merchandising to manufacturing, we looked at what a multi-step manufacturing company income statement might look like. And we are asked in this exercise to determine the amounts of the missing items. So this is pretty straightforward. We're looking for a calculation that we are missing just one number so that we can find that number. This calculation of cost of goods sold is going to look very much like what I have right here highlighted in that reference materials folder in Brightspace. So let's get started. We might be able to just start with A and go right down the list. So at the beginning of June, we had $54,900, again, using my numbers. Make sure you're doing the same calculations, but using your own numbers. So 54,900 was my beginning balance, and I added to that $252,500 worth of merchandise. And so I had available at some point during the month a total of $307,400 worth of goods available for sale. So that's the beginning balance plus what we added to it. We didn't sell all of it, and at the end of the month, we still had, in my numbers, $59,600 worth left. So if I subtract that from what I got for part A, our cost of goods sold would be $247,800. So that allowed us to just move from the top down to the bottom. But you can see, at least for letter C, we're not going to be able to do that. We have to think about this a little bit differently. And so in the second column, we are told that the cost of goods available for sale was $182,400. We know of that amount, $19,200 was already available at the beginning of the month. So if we subtract that from the total goods available for sale, that's going to tell us how much we actually made during this month. And so goods available for sale minus the beginning inventory will tell us how much we actually produced this month. And then if we had 182,400 available for sale, and at the end of the month, we still had 38,300 left, subtracting, I find that we must have sold $144,100 worth. And for the final column, if we had $105,600 worth of goods available for sale, and 67,200 of that was made this month, if we subtract, we find that the beginning balance must have been 38,400. And if we had 105,600 available for sale and we sold 97,200, we must have left 8,400. So cost of goods available for sale minus the cost of goods sold tells us how much we have left at the end of the period. So that's pretty straightforward as well. Again, you can use the calculation that's in the reference materials folder in Brightspace, and you're looking for, where do we know all but one? Where do we have just one variable? Let's see if we can solve that. You can always change around that formula to solve for the missing piece. Okay, again, if you have questions, just let me know. If you're watching on video, certainly feel free to email or request a meeting or whatever else would be helpful for you. I can see your assignments and I can see the numbers that you have in your assignments. So if you do have a question, I can always, just let me know, hey, I'm working on the practice set. I'm on question number 4. You can always use the email instructor button right here. I have a couple students who do that routinely. Sometimes that's very helpful because I can see exactly what you're working on right on my screen. Most of the time, I'll be honest, I have to go into Cengage to see it because sometimes the screenshot it sends me is not legible, it's too small or doesn't show enough of the screen. But at any rate, if I know what you're working on, I can easily come into Brightspace from my computer and take a look at exactly what you're looking at, and then I'll see the numbers that you're working with as opposed to the numbers that I have in these algorithmically generated problems. So our next exercise is back to chapter 16, and we are looking at a company using job order costing. And we are asked to prepare the income statement for this company. So the basic format of the income statement remains the same, except rather than looking at a cost of goods purchased to do the calculation, we're looking at the cost of goods manufactured. So that's what makes this different than an income statement we might have looked at in financial accounting. But all financial statements, all income statements are going to start with revenues or sales. And then we're going to subtract from that our cost of goods sold, but we're going to have to calculate. Oh, actually, nope, it gives us that. Sorry. Let's just go back to the beginning. We might as well do it this way. So rather than kind of describing the whole thing, we'll just do it as we go. So as I said, all income statements are going to start with our revenues or sales. And I can see the third bullet point up from the bottom, revenues earned by selling bikes. That's what we do. $2,297,800 is our sales figure. And we need to subtract from that our cost of goods sold. And it tells us right here, we sold goods with a cost of $1,283,700. So what went into that calculation would be the the same type of calculation that we have here. Excuse me, but in this case, they've given us that number already. So if we take our revenues and subtract cost of goods sold, we get what this textbook for some reason likes to call gross profit. I tend to use the term gross margin. They are the same, they mean the same thing. It's what's left of our sales dollars or our revenues after we pay for the product itself. The reason that I dislike the gross profit, we typically use that term if we're talking about a segment, a small part of just one piece of the company as a whole. We tend more to use the term gross margin on financial statements that are for the company as a whole. And so when you are looking at the company that you've chosen for the annual report project, you will more likely see the term gross margin than you would be to see the term gross profit. They can be used interchangeably. I really prefer the term gross margin when we're talking about the company as a whole. The next part of the income statement is the period expenses. And so, so the selling and administrative, or what sometimes you hear referred to as SG&A, selling, general, and administrative expenses, includes both selling and administrative expenses. Again, as I said, these are referred to as period costs. These are costs that hit the balance sheet never, and they hit the income statement in the period in which they're incurred. So unlike product costs, which stay on the balance sheet as an asset until we actually sell the product, period costs never go on the balance sheet. They hit the income statement in the period in which they're incurred. And so I just added those two pieces together to get our total selling and administrative, and then we can subtract that from our gross profit or gross margin. To get our operating income, or if the selling and administrative expenses were higher than our gross profit, that would leave us with a net loss. This is called operating income because it does not include any what we refer to as non-operating items. So any what we call below the line items, discontinued operations, effective accounting change, non-recurring large ticket items might be considered below the line. We don't see any income tax here. And so operating income includes just the continuing operations of the company. And our last part is to determine the inventory balances on February 28th, the end of the first month of operations. Well, that's an important piece of information because if it's the first month of operations, that means we didn't have any beginning balances in these accounts. So it's going to make our calculations a little bit simpler. So let's look at the materials inventory first. And let me get my annotate function up here so I can make some notes. So for the materials inventory, it started with a balance of 0. What did we add to that? It says we purchased $651,600 worth of materials. And what did we remove from that account? $560,400 was used in production. Just looking to see if it says anything about indirect materials, and it doesn't. So we will assume that that there were no indirect materials since it doesn't tell us that. So we bought $651,600 and we used $560,400. That would make the ending balance $91,200 using the numbers that I have in my exercise. So beginning balance plus purchases minus usage equals ending balance. Then we go on to the work in process. Again, it's our first month of operations. So we start with a, we start with a 0 balance. Don't know what just happened. And what do we add to that? Well, what do we add to work in process? We add our direct materials, which was 560,400. It came out of materials in the previous line here and gets added to our work in process. We also would have added direct labor, which the next bullet point down tells us was 484,000. And we allocated overhead at a rate of 80% of means times 80% of the direct labor cost. Oh, and then what did we, so that's all the things that we added to that account. What did we remove from the account? The next bullet point down, the fifth bullet point down, tells us we transferred $1,374,300 worth of finished goods. So since they're finished, we move them out of work in process and we move them into finished goods. So with the numbers I have there, I'm going to go ahead and do that math. 560,400 in direct materials, 484,000 in direct labor. 80% of that 484,000 was the applied overhead. And then we're going to subtract the finished goods. So hopefully I just did that math correctly. 57,300 is what I got. And I'll put those into the exercise in just a moment. I just can't scroll up and down when I'm using this annotate function on the screen. Finally, for our finished goods, again, first month of operations, and so we didn't have a beginning balance. What did we add to it? Well, we were told that we transferred 1,374,300 out of work in process. That goes into finished goods. And then we sold 1,283,700 of that. So I've put the 0 in there just to be clear. I put the 0 in there so that if you were working with a company that was not their first month of operations, which is certainly going to be much more common, we would know where to put that beginning balance for each one of these accounts. And so we finished 1,374,300. We sold of that 1,283,700. And so our ending balance should be 90,600. So I'm just going to scroll down here to part B, enter in all of these numbers that I just calculated, and put our green check marks in there so we can see that our income statement looks very much like, looking at it like this, it looks virtually identical to a income statement that we would have done last semester for a merchandising company. What really is different, though, is how that cost of goods sold is calculated. And so we've seen that. We know that the calculation here includes the analysis of the inflows and outflows within that finished goods inventory account. We know that in order to get the cost of goods manufactured, we have to do the report like we did in one of the earlier exercises today. All right, let's clear my drawings, and if there aren't any questions, we'll keep going. Our next exercise is going to take us into Chapter 17, and so Chapter 17 is for companies using a process costing system. So we know for companies using a job order costing system, they have just one work in process account, and they have those subsidiary ledger cards that keep track of the costs that are being traced to each individual job. Depending on the size of your company, you might have just one job in process at any given time, or you could have 500. So, but still just one work in process account in that subsidiary ledger that keeps track of costs that accumulate for each of the individual jobs. If we add together all of the costs on those job order cost cards, it has to tie out or equal match to what's in what I think of as the control account or the master account that is on the balance sheet that would show all of the work in process. you need to go to that subsidiary ledger to see any individual job. Provides the detail on that subsidiary ledger. Once we get into chapter 17, we're talking about a company that uses process costing. And so a company that uses process costing, rather than accounting for cost for a specific job, maybe they have a continuous process. And so there isn't such a clearly defined beginning and end to the process. And so instead of accounting for what happens on a specific job, they account for what happens during a specific time period. And that's what we're looking at here. A company that uses process costing may have more than one process. I would say it's highly likely that companies have more than one process. For this particular company, we can see, just looking at this quickly, they have a cutting department and they have a weaving department. And so this company, if those were the two processes that they use, they would actually have two separate work in process accounts, one for cutting, one for weaving. They would trace costs to those departments independently. And the cost of production report that we have here is going to be just for one department. So this is the cutting department. The weaving department would also have its own separate process cost report. Remember, in the reference materials folder for chapter 17, I have this Excel template that I prepared for you to use. If it helps you with your calculations, you're welcome to use that. You can use it for the exercises, the problem, the exam, wherever it's helpful. If you don't find it helpful, you don't have to use it. I personally find it very helpful because it organizes our information in a consistent format so that we know, we get used to what we're looking at. We know where to find the particular information. We know what to do with it. So I do encourage you to use that template. Ideally, you only need to enter numbers in the white spots, but I don't have this template locked. If for some reason you want to adjust the date line up here in row 2, you're certainly welcome to do that. But for our class, you're never going to be submitting this cost of production report for any purpose. It's really just kind of like your scratch paper. So use it if you find it helpful. If you don't, that's fine too. I find it very helpful. But for this particular exercise, they give us the same format here. I created that using the same format that this textbook uses so that you'd be familiar with it, so that you can use it if you wish. And we're going to get started here. Let's just look at the information that's given here. We're looking at the month of January. And you'll notice that materials were added from the weaving department. So this is a two-step process, it appears. The material starts in the weaving department, and presumably in the weaving department, they weave the carpet. And then they transfer those weavings into the cutting department, where I assume they cut the carpet, right? And so those transferred in costs are going to be treated as a separate cost being added to our account here. So let's see what it says. The cutting department of Karachi Carpet Company provides the following data for January. Assume that all materials are added at the beginning of the process. So that's one of the assumptions that we make throughout this class. Not necessarily correct in the real world. Excuse me. Not necessarily correct in the real world. It certainly could be the case that we have materials are added throughout the process. I usually use the analogy in class that if you are making cookies, some people throw all, say you're making chocolate chip cookies, some people throw all the ingredients in the bowl and then just mix them up. But some people actually follow the directions for the chocolate chip cookies, and they start with the butter in the bowl and they cream that, and then they add the sugar and they cream that together, and then they add the eggs one at a time, and then they add the other things, maybe they sift the flour and the baking soda together, and then they add that a little bit at a time or whatever. So, and then you add the chocolate chips at the end. So there are different ways of approaching things. Some people throw all the ingredients in the bowl. Some people add them one at a time, as the recipe indicates. For this class, as I have highlighted on the screen, our assumption is that all materials are added at the beginning of the process. But again, certainly in a real world scenario, sometimes that's not true. Sometimes they are added a little bit at a time throughout the process. Also, as a reminder, conversion costs are the lumped together other costs of production. So that would be the direct labor and the overhead. And we assume, again, for this class, we assume that the conversion costs of direct labor and overhead are incurred uniformly throughout the process. So if we are told here that the beginning inventory was 65% complete as of January 1st, that means in December, they did 65% of the conversion work, incurred 65% of the conversion costs already. And what does that mean? We have 35% left to complete in January. We use the FIFO approach, so you should remember that from Chapter 6 in Financial Accounting. FIFO stands for first in, first out. The assumption is that the first thing we do is finish up the beginning inventory. So those 11,200 units that were in beginning inventory, we finish those first. And then we start new units. And for those new units, some of those are going to be completed and some are going to still be in ending inventory. So in this case, the first thing we did was finish up the 11,200 units, again, using the numbers in my exercise. Your exercise may be different. We then started an additional 172,400 units during the month. We completed 174,400. That includes the 11,200 that were in beginning inventory, and then additional units from this units that were started during the month. And at the end of the month, then we had 9,200 units left. Those units were 25% complete. So let's go about putting this information into our template. And I apologize, I am going to have to scroll up and down because I do have a printout here of the exercise, but the exercises numbers in my printout are different than what's on the screen. So I'm going to have to do some scrolling up and down to transfer these numbers. So the first step, what you can see on the screen right now, this is all units. This is units only. In the first part of the cost of production report, there are no dollars involved, just doing unit calculations. So we start with the whole units. Our beginning work in process in my numbers was 11,200. And the units that we started this period was 172,400. So our job then is to account for where those units are now. So that's 183,600 units. And we have to determine where are they at the end of the period, at the end of the month. So as I said, the first thing we do is finish up that beginning inventory. Now you'll notice that the next two columns are headed direct materials and conversion costs. These units in beginning inventory, their direct materials were added at the beginning of the process. Those were started in December. And so the direct materials were added in December. So we didn't add any more direct materials in January. So I'm putting a 0 there. That will always be 0. Those units were, how much was done? Those units in my exercise were 65% complete. 65% of the conversion work was done in December. So how much does that leave to do in January? 35%. 11,200 units times 35%. That's equivalent to 3,920 whole units worth of conversion costs that we incurred. For the units started and completed in January. Well, how many units did we start in January? Right there. In my numbers, 172,400 units were started in January. And at the end of the month, 9,200 units were not done yet. They're still in ending inventory. So if I subtract those 9,200 units, the units we started and completed must have been 163,200. Again, 9,200 units in ending inventory. So the units started and completed in January. How much of the cost did we incur in January? All of it. We did all the work. We added all the direct materials and all of the conversion costs, all of the direct labor, all of the overhead for those units. So we first finished up the beginning inventory, then we had some units started and completed. If we add those two together, we get 174,400 units were transferred to finished goods in January. That is consistent with what the exercise tells us. Didn't need to tell us that, but we could have figured that out on our own. We added 163,200 units of direct materials, and then I need to add these two pieces together. 167,120 is the equivalent units worth of conversion costs that were incurred during the month of January. And I just added down. Next line, ending work in process. Well, we added all the direct materials as soon as we started those units. So that's 9,200 units worth of direct materials. But those units weren't done. How much did we do? Well, the work in process at the end of the month was 25% complete. We did 25% of the work in January. 9,200 units times 25%. That's equivalent to 2,300 whole units. Now I just need to do a little bit of addition here. Add those two lines. You'll notice that this number, 183,600, must be equal to this number. This number is the total units accounted for and must be equal to this number right here. Keep adding down, just the two lines just above. Okay. And so now we finished the first part of the report, and those are the unit calculations. So now we'll be able to, in the second part of the report, assign our costs to those units. Okay, so if everybody's okay with that, let's go down. Our next step is to calculate the cost per equivalent unit. So we need to put in our costs that were incurred in the month of January. Again, this column is for direct materials. The next column is for conversion costs. So how much did we add for direct materials? Materials added during January, there it is. Whoops, just that number, $1,361,960. $960, yep. And then our conversion costs. How much did we add for conversion costs during the month? Well, we have direct labor of $251,589, and we have some overhead that was applied, $307,497. And so the total for the conversion costs that were added during the month, $559,086. The direct materials were for this number, 172,400 units from my exercise. Again, your number's probably different. And for conversion costs, here are the units for the conversion costs from the previous step, 169,420. And so we have the total costs and we have the total units. So we can divide cost by unit to get the cost per unit. $7.90 for direct materials. And $3.30 for conversion costs. So let me just scroll up here again. So we have $7.90 and $3.30. Let's see how those compare to the previous month. In December, direct materials cost $7.80. So they've gone up in price, 10 cents a unit. And conversion costs also have gone up 10 cents per unit from what the costs were in December, where these are the costs that are in beginning inventory that came over from December. Just interesting. Now, let's finish this step by figuring out what are the total costs that we need to account for. So our beginning inventory It's right there. 110,656 was our beginning inventory. 110,656. What did we add to that in January? I don't even have to scroll back up because I have the direct materials here and the conversion costs here. I just need to add those two together. To get the costs incurred in January, add that to the beginning balance to get the total cost to be accounted for in the cutting department. And when we do this final step, that number needs to match this number. So the bottom line of the production cost report gives us another way of tying out our work to see, did we do this right? So let's go about assigning the costs. So as I said, we're using really the FIFO approach, first in, first out. So the first thing we do is finish up that beginning inventory. The beginning inventory already had a cost from right here. The work in process at the beginning of the month in my numbers was 110,656. Well, what did we have to add to that to finish those units? If I just scroll back up to that first step and look at this line, what did we have to add to it? Well, we didn't have to add any direct materials, but we did have to add 3,920 units of conversion cost. Conversion cost for the month of January cost us, excuse me, $3.30 per unit. So I didn't have to add any direct materials. Again, these columns line up under the direct materials and then the conversion cost column. So I didn't have to add any cost for direct materials, but I did have to add 3,920 units at $3.30 each. I'm multiplying those two together. 3,920 units at $3.30 is a total of $12,936. And then I'm going to add across 0 plus 12,936. And then I'm going to add down. So those units already had $111,000 of cost at the beginning of the month. We added another 13,000. And so for those units, when we transfer them to finished goods inventory, they transferred with a total value, total cost of $123,592, again, using the numbers in my exercise. Started and completed in January. That was 163,200 units. 163,200 units of direct materials at $7.90 each. And then 163,200 units of conversion cost at $3.30 each. Add across to get the total for those units started and completed in January. Add that to the cost of the beginning inventory. And we get the total that was transferred to finished goods in January. And finally, we can assign the cost to our ending inventory. So here's our ending inventory line for our unit calculations. We have 9,200 units of direct materials and 2,300 units of conversion costs. Remember, those units aren't done. They have all of the direct materials at $7.90 each, but they have just 25% of the conversion cost. That number was given. 25% of 9,200 is 2,300 units times $3.30 per unit. Again, add across. And then I want to add down and make sure that my number does match. And it does. And so that's the cost of production report. We could have done the same calculation in the Excel template that I provided to you for some of the exercises in the chapter. That made it much easier because this had the report here. The only thing that using Excel would have helped with is I could have just put the formulas into Excel, but then I would have had to transfer all the numbers into this template anyway. So it wouldn't have saved us any time for this exercise. And I already talked about both of these. So comparing to the previous month, we saw that this month we had an increase in both the direct materials and the conversion costs of 10 cents. How do I know that? Well, right here in the middle of the report, we calculated the cost per unit for January, and we were given up here at the very top of the problem, the cost per unit for the beginning inventory, which would be the costs incurred in December. So it went from $7.80 to $7.90 for direct materials and $3.20 to $3.30 for the conversion cost. That's an increase of 10 cents for each. Okay, so I'm not hearing any questions. I'll assume that everybody's good with that. And we can move on. So our next final two questions are from chapter 18. So this is the activity-based costing. What makes the activity-based costing different from the traditional approach is that we use more than one rate for applying overhead. And so our first exercise is still not really activity-based because the costs we're going to divide up based on departments, not based on what we're doing, kind of where it's being done, as opposed to what we're doing. Activity-based costing is based on, as it says, the activity that you're doing, which could happen in multiple departments. You're probably doing the same activity, things like cleaning and maintenance, you're doing in multiple departments. But this exercise, as I said, is the super traditional single plant-wide approach. And then we'll look at a multiple production department. So we're going to divide it by fabrication and assembly separately, which is still, again, not really activity-based costing. It's a step in the right direction because it hopefully will still improve our understanding of where our costs are actually arising in the production process. Okay, the management of Nova Industries Incorporated manufactures gasoline and diesel engines through two production departments, fabrication and assembly. Management needs accurate product cost information in order to guide product strategy. Presently, the company uses a single plant-wide factory overhead rate for allocating factory overhead to the two products. However, management is considering the multiple production department factory overhead rate method. The following factory overhead was budgeted for Nova, so a total of $792,000 split between the two departments. You can see that direct labor hours for each of the two departments was the same, okay, 4,400 hours. In addition, the direct labor hours used to produce a unit of each product in each department were determined from engineering records. And so you can see that for the gasoline engine, it takes more time in assembly, and for the diesel engine, it takes more time in fabrication. But it's a total of 4 direct labor hours for each of the products. So if we use one single plant-wide rate, they're each going to get the same cost applied to them, right? Based on the equivalent direct labor hours. But if we look at the costs here, the fabrication department costs a lot more than the assembly department does in terms of the overhead, right? So it's not quite 3, what is it, 2.5 times as much cost in factory overhead for fabrication. Well, which engine takes more time in fabrication? The diesel engine takes more time. And so if even just looking at it without doing any math, it's clear to me that we should be applying more overhead to the diesel engine because it takes more work in the department that costs more. And so if we use a single plant-wide rate, again, we'll look at the numbers in just a moment, but if we look at a single plant-wide rate, we're going to be applying too much overhead to the gasoline engine, which takes the same amount of time overall, but most of its time is spent in the assembly department, which is cheaper. And for the gasoline so for the gasoline engine, we'd be applying too much overhead. And for the diesel engine, again, same amount of time overall, but more time spent in the more expensive department. If we don't recognize that, and we just use a single plant-wide rate, we're going to be under allocating overhead to the diesel engine, under costing that, not really recognizing the true cost of producing that product. To the extent that we then use that to set a price we're going to charge our customers, we're going to be charging too much for the gasoline engine, not enough for the diesel engine. And so what does that mean in the long run? We're going to lose some sales on the gasoline engine probably because we're too expensive, and we might pick up some sales on the diesel engine, but maybe not even be covering our costs, certainly not achieving the profit margin that we think that we should or plan to. Let's look at the numbers. Letter A says determine the per unit factory overhead allocated to the gasoline and diesel engines under the single plant-wide factory overhead rate method using direct labor hours as the activity base. So single plant-wide rate, we take the total overhead given there as in my exercise as $792,000. Yours may be different. And then we divide by the total of the activity base. 8,800 hours total. So that gives us a rate, put this here, of $90 per direct labor hour, right? $90 per direct labor hour given my information. And the gasoline engine takes 4 hours. Oh, sorry, I've got my caps lock on there. The gasoline engine takes 4 hours. The diesel engine takes 4 hours. We're allocating $90 per direct labor hour to each one of those 4 hours. That's a total of $360 applied to each one, because they happen to both take the same number of direct labor hours. $360 to each one. Now, from what we already discussed as we were just reviewing the problem, seeing what kind of information was given to us, we know that that's not a very good estimate, because we know that the diesel engine is using more of the fabrication time and the gasoline engine's using more of the assembly time, and assembly is cheaper, frankly. So for letter B, clear that off my screen. For letter B then, we're asked to determine the per unit factory overhead allocated to the gasoline and diesel engines under the multiple production department factory overhead rate method using direct labor hours, again, as the activity base for each department. So I'm going to scroll back up here so that I can see the information I need. So we're going to do each department separately. So let's start with fabrication. The total cost given for fabrication is $572,000, and that's for 4,400 hours. 572,000 in my numbers divided by 4,400 hours is $130 per direct labor hour. And for assembly, no, I'm not going to abbreviate that. For assembly, we have $220,000 total divided by 4,400 hours gives us $50 per direct labor hour. So now we know the cost per direct labor hour, and we can come down and apply those first to the gasoline engine. So the gasoline engine, $130 per direct labor hour for fabrication, and it takes 1.2 hours for fabrication, and $50 per hour for the 2.8 hours that it spends in assembly. The diesel engine takes 2.8 hours in fabrication at $130 each, and then just 1.2 hours in assembly. And so that is $296 for the gasoline engine. And $424 for the diesel engine. So as I said, as we were just reviewing it and seeing, what kind of overall impressions we could gather, we knew that using a single plant-wide rate was going to overcost the gasoline engine and undercost the diesel engine, because the diesel engine uses more of the more expensive fabrication department. And so looking at letter B, we can see that although it's a bit more work, because now we have two application rates or allocation rates we have to track. So it is an extra step. It is an extra calculation we need to do. But looking at this, I would say that the difference is worth it to do the extra step, right? You wouldn't want to take that extra step if it didn't give you a significantly or meaningfully, or what we say in accounting, materially different result. Why make it any harder than it needs to be? You only use the harder method if it gives you better results, right? So let's look at part C. Which one should management use? Management should select the multiple department factory overhead rate method of allocating overhead costs. The blank factory overhead rate method indicates that both products have the same factory overhead. So that's the single plant-wide factory overhead rate method indicates that both products have the same factory overhead per unit. Each product uses the direct labor hours equally in total. That's right here, the 4 hours total. Thus, the single plant-wide rate method avoids, I missed that avoids. Let me read that again. Thus, the multiple department rate method avoids the cost distortions by accounting for the overhead in each production department separately, because they don't use the two departments equally, even though overall they use the same number of direct labor hours. They're not the same within each department, and the department's costs are not the same. Oh, okay. Sorry. Each product uses the direct labor hours. I read too much into that. It uses them differently within each department. I thought it was asking, it uses the same overall. So it uses them differently. My apologies for that. It uses them differently in that, as we've been saying, it uses, the gasoline engine uses more of the cheaper and the diesel engine uses more of the more expensive department. So I misread what that very short sentence was asking. I thought it meant in the single plant wide rate, it uses them equally. Okay, everybody's good there? Okay, we'll go on to our final exercise. Activity cost pools, activity rates, and product costs using activity-based costing. Caldwell Home Appliances Incorporated is estimating the activity cost associated with producing ovens and refrigerators. The indirect labor can be traced into 4 separate activity pools based on time records provided by the employees. The budgeted activity cost and activity-based information are provided as follows. So they've already done the calculations for us, but certainly it would be reasonable if we were given the total cost of procurement and the number of purchase orders, we could, oh no, that already is the total, sorry. So they haven't done the calculation for us. So we have the total cost here, and then we know we're going to be allocating it based on number of purchase orders. Sorry about that, brand new book. I haven't done these exercises before. Then we have the estimated activity-based usage for the 2 product lines. And had I scrolled down, I would have seen letter A says determine the activity rate for each activity cost pool. So we start with procurement. The total cost for procurement in my version is $12,600. And we're going to allocate that based on purchase orders, and there are 700 total purchase orders. So divide by 700, and we get a cost of $18 per purchase order. Scheduling has a total cost in my exercise of $90,000, and we have 1,200 total production orders, which is the activity base there. So $90,000 divided by 1,200 production orders. Scheduling has a cost of $75 per production order. Go ahead and do the next two. Materials total cost divided by number of moves. And finally, product development total cost divided by number of engineering change orders, which is our activity base. So once we have the activity rates for each item, for each activity, excuse me, we can assign that or allocate that out to each one of the products. So let me get my annotate function up here. I'll put my calculations here on the screen, and we'll start with ovens. So for ovens, they have 400 purchase orders for the ovens at a cost of $18 per purchase order. And for scheduling, they have 800 production orders for ovens at a cost of $75 each. Give myself a little more room here. For materials handling, ovens have 300 moves at $22 each. And finally, 80 engineering change orders at $250 each. And we can assign cost to refrigerators. The next line, 300 purchase orders for refrigerators at $18 each. 400 production orders at $75 each. 200 moves at $22 each, and 120 change orders, engineering change orders, and those are the most expensive item at $250 each. So that's going to be the total that's assigned for cost. And what we're asked to do, though, is to calculate the cost per unit. So I'm just going to bracket that piece in and then divide by the number of units. So that's 1,000 ovens. And again, I'm going to stick, whoops, maybe stick the brackets around this. And there are 500 refrigerators. So inside the brackets is the total cost for ovens and refrigerators respectively. And then we have to divide by the number of ovens and refrigerators. So I got $93,800 for ovens. So that's, whoops, $93.80 per unit, assuming that I punched that into my calculator correctly. And for refrigerators, I got, using my numbers, a total of $69,800 divided by 500 units, or $139.60 for activities for refrigerators. And again, as I already pointed out, the reason the refrigerators are so much higher than the ovens is because the refrigerators are a heavy user of the most expensive activity, which is engineering change orders at $250 each. So that's why you see that difference between, you know, the overall cost of ovens and refrigerators. So ovens only had 80 change orders, and that's for 1,000 units. Refrigerators had 50% more and only half as many units. And so that is the end of our practice set. As I said, if you find this useful and you just want to try one or more of the exercises more than once, you can always hit submit assignment, and then restart it is set to allow you to do it an unlimited number of times, and it should give you different numbers each time. So I'm going to stop the recording. Thank you for joining us.